Welcome to LuckScout Economic News. The Federal Reserve concluded its latest policy meeting with a decision to hold interest rates steady. This decision comes after a series of aggressive rate hikes that began in early 2022, aimed at curbing rising inflation and stabilizing the economy. This pause in the rate hiking cycle marks a significant moment, as it allows the Federal Reserve to take a step back and evaluate the effects of their previous actions. The aggressive rate hikes were implemented to address the rapid increase in inflation, which had reached levels not seen in decades. However, the Fed signaled that this is likely a temporary pause. They emphasized that the decision to hold rates steady does not mean that the fight against inflation is over. In fact, the Federal Reserve remains vigilant and ready to act if economic conditions warrant further intervention. They hinted at the possibility of further rate increases later this year. This cautious approach allows the Fed to monitor economic indicators closely and respond appropriately to any signs of persistent inflation or economic instability. The Fed aims to bring inflation down to its target of 2%. Achieving this goal is crucial for maintaining the purchasing power of consumers and ensuring long-term economic stability. The central bank's commitment to this target underscores the importance of price stability in fostering a healthy economy. This pause allows the Fed to assess the impact of previous rate hikes. By analyzing data on employment, consumer spending, and other key economic indicators, the Federal Reserve can determine whether their actions have been effective in slowing down inflation without causing undue harm to the economy. It also gives them time to evaluate the evolving economic landscape. The global economy is constantly changing, and new challenges can arise unexpectedly. By taking a moment to pause, the Fed can better prepare for any future economic shifts and adjust their policies accordingly. The Fed remains committed to combating inflation. Their primary goal is to ensure that inflation does not become entrenched in the economy, which could lead to long-term economic difficulties. The central bank's actions are guided by this commitment to maintaining economic stability. They are prepared to take further action if necessary. Whether it involves raising rates again or implementing other monetary policy tools, the Federal Reserve stands ready to do whatever it takes to achieve their inflation targets and support a stable economic environment. Federal Reserve Chair Jerome Powell delivered a press conference following the policy announcement. His comments suggest that the Fed is not yet finished with its fight against inflation. Powell acknowledged that inflation has moderated somewhat. However, he emphasized that it remains too high. Powell's tone was decidedly hawkish. He indicated that the Fed is prepared to raise rates further if inflation does not continue to decline. The Fed's economic projections suggest the possibility of 2 more rate hikes this year. This indicates the Fed's commitment to bringing inflation under control. Oil prices have surged in recent weeks, driven by a combination of factors. The Organization of the Petroleum Exporting Countries, OPEC, and its allies, known as OPEC+, announced further production cuts. These cuts aim to support oil prices. They have contributed to a tightening of global oil supplies. Adding to the upward pressure on prices are ongoing geopolitical tensions. The conflict in Ukraine continues to disrupt energy markets. Uncertainty surrounding future supplies from key producing regions is also a factor. This combination of factors has created a volatile environment for oil prices. The recent surge in oil prices presents both challenges and opportunities for investors. Higher oil prices can negatively impact companies with high energy costs. However, it benefits energy producers and related industries. Investors should consider diversifying their portfolios. Investing in energy stocks can provide a hedge against inflation. Master Limited Partnerships (MLPs) offer exposure to the energy sector with potential tax advantages. It's crucial to carefully assess the risks and rewards associated with energy investments. Don't let emotions drive your decisions. Consult with a financial advisor to develop a sound investment strategy. The U.S. labor market continues to demonstrate resilience. showcasing its ability to adapt and thrive even in challenging economic conditions. The economy added a significant number of private sector jobs last month, surpassing many analysts' expectations and providing a boost of confidence to both businesses and workers. This indicates that businesses are still hiring despite rising interest rates and economic uncertainty, reflecting a robust demand for labor across various sectors. The unemployment rate remains near historic lows, a testament to the strength and resilience of the labor market. This low unemployment rate means more people are finding work, which is crucial for economic stability. This strength in the labor market is a positive sign for the overall economy, suggesting that businesses are confident in their growth prospects and are willing to invest in their workforce. It suggests that consumer spending, a key driver of economic growth, is likely to remain strong. When people have jobs, they have money to spend, which in turn supports businesses and fuels further economic activity. However, a tight labor market can also contribute to wage inflation. As businesses compete for a limited pool of workers, they may need to offer higher wages to attract and retain talent. This is something the Federal Reserve is closely monitoring. Wage inflation can lead to higher overall inflation, which the Fed aims to control through its monetary policy tools. Balancing job growth with inflation control is a delicate task for policymakers. Additionally, the strong labor market has implications for future workforce development. Educational institutions and training programs are essential in preparing the next generation of workers to meet the evolving demands of the job market. Infrastructure projects and other large-scale investments also benefit from a healthy labor market, as they require a steady supply of skilled workers to be completed efficiently. Small businesses, often considered the backbone of the economy, are particularly impacted by labor market conditions. Their ability to grow and thrive depends significantly on their capacity to hire and retain employees. In conclusion, the resilience of the labor market is a cornerstone of economic health, influencing everything from consumer spending to business investment and policy decisions. As we move forward, maintaining this strength will be crucial for sustained economic prosperity. As we delve into the intricate dynamics of wage pressures, it's crucial to understand their broader economic implications. While the pace of wage growth has moderated somewhat, it remains elevated. This trend is evident across various industries, reflecting the ongoing demand for skilled labor. This is particularly true in sectors experiencing labor shortages. Industries such as construction, healthcare, and technology are grappling with a limited supply of qualified workers. The continued upward pressure on wages can contribute to inflation. When businesses face higher labor costs, they often pass these costs on to consumers in the form of higher prices. Businesses may raise prices to offset higher labor costs. This can lead to a cycle where rising wages and prices feed into each other, creating sustained inflationary pressures. The Federal Reserve is closely watching wage growth as it assesses inflationary pressures. The central bank's primary goal is to maintain price stability while fostering maximum employment. Strong wage growth can make it more challenging for the Fed to bring inflation down to its 2% target. Persistent wage increases can signal underlying inflationary trends that are harder to control. The Fed may view persistent wage pressures as a sign that further interest rate hikes are necessary. By raising interest rates, the Fed aims to cool down economic activity, thereby reducing inflationary pressures. However, this approach can also slow down job growth and economic expansion, making it a delicate balancing act for policymakers. In conclusion, the interplay between wage growth, inflation, and Fed policy is complex and multifaceted. Understanding these dynamics is essential for anticipating future economic conditions and making informed decisions. The latest Consumer Price Index data indicates that inflation cooled slightly last month. This deceleration in the overall inflation rate is a welcome sign. However, it's important to note that inflation remains above the Federal Reserve's target. Certain categories, such as shelter and medical care, continue to experience significant price increases. These rising costs can put a strain on household budgets. They also highlight the challenges in bringing inflation fully under control. When analyzing inflation, it's crucial to look beyond the headline CPI figure. Understanding sector-specific price trends can reveal investment opportunities. For example, the continued rise in shelter costs could benefit real estate investment trusts, or REITs. Similarly, rising medical costs could present opportunities in the healthcare sector. Investors can consider healthcare stocks or exchange-traded funds, also known as ETFs, that focus on companies well-positioned to benefit from these trends. Remember, diversification is key. Investing in an environment of elevated inflation requires careful consideration. Inflation erodes the purchasing power of money over time. This means that the returns on your investments need to outpace inflation to maintain their real value. Consider investing in assets that have historically acted as hedges against inflation. These include real estate, commodities, and certain types of stocks. Value stocks, which tend to be companies with strong fundamentals and a history of paying dividends, can also provide some protection against inflation. The current economic environment, characterized by high inflation, rising interest rates, and geopolitical uncertainty, calls for strategic portfolio adjustments. Review your investment portfolio and make sure it aligns with your risk tolerance and financial goals. Consider diversifying your portfolio across different asset classes. This can help mitigate risk and potentially enhance returns. If you're unsure about how to adjust your portfolio, it's always a good idea to consult with a qualified financial advisor. In today's rapidly evolving economic landscape, staying informed is more critical than ever. Keep abreast of economic news and developments. Understand how these events might impact your investments. Don't let emotions dictate your investment decisions. Instead, rely on careful analysis, a well-defined investment strategy, and sound financial advice. By staying informed and making strategic decisions, you can navigate the complexities of the market and work towards achieving your financial goals.